Well, Andrea, thank you so much for joining me again. I know last time we had a lot of fun just getting to know your personal history. We didn't get to touch on what you're currently doing, which I think is extremely interesting and relevant to our audience. So, as a quick reminder for the folks that may not have listened to the last episode, you had a very interesting story and a very different way of getting into the investing world. I mean, you started off working on the beach in your hometown as a kid. You then became a professional soccer player at the age of 15. By the time you were 18, you're injured and had a midlife crisis, trying to decide like what is next for your career. Came to America, didn't speak the language, started knocking on doors of restaurants to see if they would hire you. You got a job, worked your way up through the restaurant chain all the way to like managing a restaurant. Went back to school, learned English, got a job at Newburger Berman. And is that right? Was that your first job? Yeah.
Yeah, yeah.
And and then you managed to work your way all the way to your current position at StepStone. So first of all, I mean, like, what an incredible journey. I think it is very inspiring to people who may not have had that traditional, investment banking background, and there are alternative ways to get into this industry. So yeah, we'd love to now spend some time learning more about what you're currently doing to learn about the really interesting world of the secondaries investing. Andrea, thanks again for joining me for a second time.
Thank you for having me.
Cool. So yeah, tell me more about secondaries. I think it's obviously a relatively new asset class, and it's probably not something that most people are aware of. So take a step back and tell us a little bit more about what that means.
In the pure bond, so the pure bond explanation of what we do is we buy LP interest in private equity funds. So private equity is a very liquid strategy. You are generally locked up for 10 plus 2 on average. I remember a few years ago, I was reading a statistic that on average, a traditional buyout fund lasts 16 years. So that's the average. And actually now we're seeing more and more funds being pushed out. So probably the 16-year mark average has probably increased over the past years. And so there's a point in time where you may desire to sell your private equity exposure. And since there's not a liquid secondary market the same way that there is for liquid investment for stocks, the private equity secondary market has sort of grown out of a necessity for liquidity from private equity investors. So we are a tangential market. The secondary market has experienced over the past few years. It's basically just a function of the growth in the primary market plus some market share, meaning it has become more and more common for private equity investors to generate liquidity, not only organically by holding portfolios, but also proactively selling and using this opportunity as a more of the secondary market opportunity as a more of a portfolio management tool to manage their illiquid investments.
Yeah, it's super interesting. Most people are familiar with the stock market and how you trade stocks there. I think it's important to compare and contrast the two because in some ways they're very similar. Like most people, like, unless you're IPOing, when you're buying or selling a stock, you're doing a secondary transaction. The easy way to describe this, like a primary transaction, means that when you're selling shares to somebody, the company gets that money. A secondary transaction is now when the investors are selling amongst each other, so that none of that money ends up going back into the company. And public markets have developed a lot of rules, regulations, precedents on how you can trade such things. But then you had a lot of downsides to public investing, which is why private markets, private equity, private credit, private debt have become so compelling, because you're some of the main ones that you're not constantly being watched and judged by everybody on a daily basis. You have like more flexibility as an operator of the company to be able to pursue long-term visions without having to check in all the time and explain every single market move. But what I found really interesting is that the private and the public side are starting to become more similar. I mean, with what you guys are doing is providing secondary liquidity in the private markets, it is more akin to the public stock markets that people are aware of. And yet there are some very significant differences. It's kind of like this is, like the Marvel like superhero parallel universe where you have publics that develop this in their own way over many years, and then privates within a much shorter time span have replicated some of the features, but not all of them. So I'm curious how you think about the distinction between private markets and public markets, especially from a secondaries perspective. What is the secondaries market in privates? How is that different in your mind from the public side?
So I'm going to reference one more time. I do it like 3-4 times a day. Matt Levine. I don't know if you're a subscriber to his Money Stuff newsletter, but
Yes.
he likes to say that the private markets are the new public markets. So I actually believe with what he says, and I'm not a big fan of public markets. I'm not fan of the volatility in the public markets, which we had a very long discussion on once we met the first time. But also one other thing that Matt always says is the best thing that a broker can do to you is not picking up the phone when there's a market panic and when everybody's selling. And the beauty of the private equity markets from this perspective is generally you are expected to generate a liquidity premium in private markets. But at the same time, you can actually view it as smoothing out returns by not being able to sell or buy assets on a daily basis. The secondary market, the private secondary market there's still quite a bit of friction when a transaction happens. So when you buy a stock on a secondary market, you usually place an order with a broker and, T+3, and you have the stock in your account and it has settled. Whereas in the private equity secondary market, can take up to a minimum of 2-3 weeks if you really want to rush through things, but it's actually a much longer process that involves lawyers, involves tax counsels. It's not as smooth. And so it's not like selling a stock. And the reason being that all investors are treated equal, but they're not all equal. And so when you commit to a private equity fund, you have to make certain representations. You need certain, tax treatments, or you might have certain requests that or options that the private equity fund gives to you. And when these get transferred, as a buyer, you need to make sure that you know what you're stepping into, because each LP interest is different. Unlike stocks where sort of every stock looks sort of the same. And this creates liquidity. There is still friction over the years, for the past at least 10 years, 10, 11 years that have been in the market, but even longer than that, there have been some players that tried to build a sort of liquid market for private equity interest, but no one was really able to crack the system. There's a lot of talking about tokenization of LP interest, but I think it's may work on the very lower end of the market for maybe retail investors that they don't have any particular rights. But once you look to buy LP interest from large pensions, or foreign investors that have to deal with ECI or particular tax treatments, it's inevitable that you're going to encounter some friction that will make the market more illiquid. And you will need specialization in this, and that's where we come in.
Would you say that this friction is actually not a bug, but it's a feature of these markets? Because to your previous point, it slows things down, it weeds out certain investors, and it's a different style of investing that has benefits. Like, would you agree with that?
I definitely agree with that. It's one thing that people don't always realize is that private equity investments are investment in closed-end funds where the GP, the general partner, has the right to accept or not certain investors within the fund. So you as a GP, you want control over who gets access to your fund, who gets access to the information that you post, who gets access to the secret sauce about your investment capabilities. And so if I'm a large cap GP, I would not want one of my competitors to sort of peek into my quarterly reports and know what's going on with my business. So anytime there is a secondary transfer of an LP interest, me as a buyer, I step into the shoes of an existing investor. We agree on a price, we agree on the transfer, we agree on the responsibilities, on the liabilities, on representations, all good. But ultimately, we need to get a signature from the GP that says, yes, I now accept you, Andrea Pompili, as a new LP instead of LP XYZ. And so, there is friction that is going to be there, and the GP itself wants some certain representations and wants to know that me, Andrea Pompili, as an investor, I am qualified to be an investor in the fund. They don't want a potentially defaulting LP in their fund. And so these are many of the reasons why this market cannot, and probably will never be as liquid as the traditional secondary market for listed stocks.
Yeah, and the part that's interesting to me is that in the private markets, exactly to your point, is that you can legally get access to information that is asymmetric, that other people do not have this information. Exactly to your point. Like I specifically do not want my competitors to get access to my information. I do not want any investor to be joining my company. And in that way, it is much more similar to how like a regular company operates. Right. If you're just a small business somewhere, you're not going to tell, your mom every day how your business is doing. And you might not accept anybody to just be your partner. It is the same kind of selection process that you have with employees, which is very rigorous. And yet the listed, like the public markets, the reason why they mandate that kind of transparency is to make it fair for everybody. And you want to have access to all the information because we've seen how that can go poorly in the past. But I think it's a very ingenious, I don't know, like very American way of doing things where it's like, okay, we got burned in the past. We're going to create all these rules and regulations to make sure that people don't get screwed and defrauded. And yet we're also going to come back with like, here's another version of doing this that we can still have access to this like asymmetric information where it's not open to everybody, but it still is legal because the main reason why these, the SEC and all these things were founded is to protect the little guy, that it does not have all these relationships, can't get into all these funds. And you're like, okay, fine. The way we'll workaround is like, we're just going to exclude them. Like you have to be a qualified investor to even be considered to have access to this fund. And the funds can say no to you if they don't want you to buy their interests. And so, yeah, it's such a fascinating like dual market that has sprung up around this to ultimately, like in my opinion, part of it is to get around these regulations. If we didn't have these regulations in the first place, there wouldn't be a distinction between public and private. And what we've seen, I'd love for you to talk more about this, is that the performance of the private markets, at least over the past like decade or so, have been phenomenal, right? Relative to the public market. So it sounds like it is working. So all these weird quirks of the market infrastructure seem to generate better returns. Is that true?
Yes, definitely. I mean, look, the way that I view public markets, and that's a very personal view. Anytime I think about the public markets, to me is just a mean to liquidity. So when I look at a portfolio, when I look to buy a portfolio, I look at the underlying assets and I try to estimate what the exit path, route, and potential value creation is for each one of them. And anytime there is a company that has grown a bit too much, to me, the reliance on an IPO is actually almost a red flag. Because if that company IPOs, I might get stuck in it for another 2-3 years until I'm able to fully sell down the entire position, which creates timing risk, creates mark-to-market risk, because then I'll have to start valuing the company on the purchase, on the stock price, rather than on sort of intrinsic metrics that you can argue whether they are right or wrong, but you value the asset on a performance metrics rather than just vibes from the public markets. And if you look at the performance of companies that were backed significantly by private equity firms, I remember when Facebook IPO'd back in the days, or when Uber IPO'd, like they dipped shortly after IPO, because everybody was, if I'm a private equity investor, I've been in this company for 5-6 years, I've already made, a huge return on my equity. I just cannot wait to get liquidity back to my investors. And so when I'm a, this is a long way of saying I'm kind of skeptical of IPOs from private equity backed companies, because I know the need and the willingness to get liquidity from this fund. They're not willing to sell at any price, but once you make, I don't know, 6, 7, 8 times your money on an investment, if you lose a turn because of the liquidity, because the stock goes down, you're willing to take it as long as you get the cash back to your investors.
Yeah, no, that's a great distinction because again, back in the day, IPOs were the primary means of getting access to capital for your company, and you'd want an IPO as soon as possible. But now that we have the private markets, it is much easier for a company to get access to that capital than it is to IPOs. That's why every company does it, from VCs to private equity, et cetera. And so, and then, yeah, exactly to your point, the moment you IPO, that is now the destination. It is no longer the beginning of the journey. Like Microsoft back in the day when they wanted to raise some money, like super early on, like, oh yeah, the moment you IPO, everybody wants to sell, including the private equity owners, the founders, everyone wants to get some liquidity. And unless you can find a similar or greater number of other investors to come in and buy the stock, then yeah, like these, there's that risk of these not quite forced sellers, but very incentivized sellers the moment that this thing becomes public. So yeah, that's a very interesting point.
Yeah. Plus, sorry, one thing that I did not mention: as long as you're private, you have minimal disclosure to be made to anyone about your business. Whereas, the moment you go public, you're almost open kimono with the market, with your competitors, with investors, with everyone. And there is friction there as well. You need to have, a CEO that is capable to managing assets in the public markets. You need to have a very strong CFO that will be able to present your earnings on a quarterly basis. You need to build out teams that do, the quarterly reports and earnings. You don't have to have any of that as a private market, as a private firm. And that's why you can also be a bit more creative, and you can be more, can have a more long-term vision, because you don't care about taking a hit this particular quarter to have a much better payoff in a year's time. Whereas if you need to look quarter over quarter, you might not want to make the decision once you're public. That's why, in my view, private investments have performed better over the past, couple of decades compared to public markets.
Yeah, I mean, it really does go back to regulation, and there is a significant cost to complying with that regulation. To your point, like all these filings, all the people they need to bring on board, the lawyers, etc. And that's what makes it more complicated. We're actually working on a couple of things on our side where some of our clients are looking to take public companies private for exactly some of these reasons, but in reverse. It's like we can calculate what the cost savings would be, and and that's not even to say, okay, the company can operate better in a private environment because there's less scrutiny, but it's just like you will no longer need to have as big of a paid board. You're not going to need to pay for all the things that are required to comply with this, and it can be pretty significant because at the end of the day, that's going straight to EBITDA. So if you can, depending on the size of the company, you can significantly grow EBITDA, especially for like some of these like less profitable companies, by turning them private. And immediately you can have, yeah, 10, 20, 50% like growth in EBITDA just by not having to comply with all these regulations. And yeah, so I think there are some very solid reasons as to why private companies tend to outperform. And not to mention compounding, right? Because you do this once, fine, but you pay these costs of going public for a decade, and people love to hate on fees that different GPs make. But yeah, and you can look at the compounding over a long period of time. There's all these analyses around like passive investments and how they outperform like the average active investor because of fees. And then yeah, we do the same thing here. We have these significantly raised costs of compliance over a long period of time can really start to take a hit on these companies relative to their private peers. So I wanna like go back to a point you made earlier, which was around information and knowing who these funds are, getting access to these funds. Is whenever there's a lack of information or lack of disclosure, there will still be a need for that. And an entire industry started for these investment consultants to be able to be the bridge between LPs and GPs. Tell us more about that. I mean, you're currently working for one, but I'd love to kind of start a little bit closer to the beginning as like why these consultants started in the first place, what their business model was, and then we can get to how that's evolved to today.
Yes. So full disclosure, I've always worked for fund of funds that had a full suite investment platform. So both Neuberger Berman, Hardwood West, and StepStone, they're full-fledged fund of fund models with primary capabilities. So making investments into private equity funds, co-invest alongside them, and capitalizing on secondary opportunities on the funds that you are an investors in. There are some funds that are specialists in secondaries, which they don't benefit from the flow of information between the different parts of the house. But again, I've had the benefit of working on sort of the same type of firms for, since the beginning. So that's what I know. And I wouldn't necessarily know the value of being in a pure play secondary fund, because I mean, I see the value that there is in having multiple touch points with GPs. So you're talking about consultants. The same way there is friction in buying a private equity interest or investing in private equity, you can make a parallel with the traditional public stock market. And you pick and choose your stocks. You decide that something is worthwhile investing in, and you just, again, go on your broker's account, you select the ticker, you buy. In private equity, it is different. It is different because you need to have a relationship with the GP, with the manager that you want to invest in. You cannot just open up a brokerage account and pick which fund to invest. You also need to be accepted by that particular fund manager. And so the consultants or the primary investors, like, again, Neuberger, Hardwood West, now StepStone, they are relationship specialists, so to speak. So they own relationships with the best managers in the world. They try to assess which managers are expected to outperform the market, and they give clients access to these GPs, to these managers. Not everybody is born equal. Not everybody has the same capabilities. At StepStone, we might have certain relationship because of our skill on the primary side that might be superior to Neuberger in Europe. Neuberger might have an edge on certain type of investments. And so it's almost a scale game. On the primary side, you want to be as big as possible to be able to be relevant vis-a-vis the GP. And the way that I view it is sort of like an engine. So the fund of fund is an engine. Primary capital is like gasoline going into the engine. And what you take out of the engine is co-investment capital and secondary capital. The more primary capital, the more gasoline you put in, the more mileage, the more co-investment, the more secondary you get out of this engine. And so everything goes sort of in tandem, because you cannot have a co-investment business without a primary business. You cannot have a secondary business standalone. You can have a primary business standalone, but you're not going to be very successful. With them coming together, I guess it's sort of the secret formula that many of the firms I worked for and many of our peers that I've found out is the most successful secret sauce, I would say.
Tell me more about co-investments versus just straight up investing into the GPs. Why do LPs sometimes prefer them?
So first and foremost, co-investments are generally offered on a economics free basis. So the GP They come to us and say, look, we have making $1 billion investment. We want to hold 700 million in our fund. We have 300 million that someone needs to speak for. We can offer it to you if you want on a no fee, no carry basis. And so it's a way to blend down economics when you invest in a private equity fund, but also you reduce the blind pool risk of your investment because you can see what you're going to be investing your capital in. When you make a commitment to a private equity fund, you don't know what the capital is going to be invested in. It's a blind pool of capital. You will find out in 3-4 years, once the investment period is over, the portfolio composition of that particular fund. Whereas with co-investments, you basically can decide along the way what are the exposures that you want based on what was offered to you. Another thing that is helpful if you decide to invest in co-investment funds is that you sort of remove the GP centric risk that you have investing in directly in closed end private equity funds, because I've seen with a few players, maybe one senior partner retires and you see the strategy shifting and the investment sort of going downhill from that point onwards. Whereas here, you have sort of you're not putting all the eggs in one basket. You're sort of spreading the investment opportunity across multiple GPs rather than one alone.
So the way that I've been thinking about co-investments is that you're an LP, exactly like you mentioned. There's a GP that has a higher allocation than they want to handle themselves in a particular company that they like, and they'll come to you saying, hey, there's an extra 30 whatever percent. Do you want to take it on a no-fee basis? Great. Are you saying that that co-investment funds also exist that can pool this kind of how does that work? So like an LP invest a co-investment fund that then takes these partial shares and things, like, yeah, how does that work?
I don't know how fair is going to be the characterization that I'm going to make, but it's like an all-star team. If you have a big enough platform, a big enough private equity platform, you're going to be shown a lot of co-investments from most of the GPs that you're investing in. Really, investments are offered on a pro rata basis with respect to your commitment. So let's say there's $1 billion fund and I am a 100 million investor. Generally, I would be offered 10% of the co-investment opportunity that is available. In reality, my co-investment portion is going to be multiples of my pro rata. So it's not going to be 10%, it might be 20, 30, 50%, sometimes even 100% of the co-investment opportunity, because not every LP, not every investor has the capabilities to be able to diligence a co-investment opportunity. So groups like StepStone, Harborbest, eBurger, they all have pools of capital that pull together co-investments. And they're actually a pretty neat way of capitalizing on lower fees, lower carry opportunities. And the way, I call it all-star because you are sort of trying to pick the best investments from each of the GPs that you work with. And so you have a lower cost charge because generally the fees are half of what a traditional fund will pay, what a traditional fund would charge. So probably like 1% and 10%, 1% management fee, 10% carry compared to 2 and 20. But also you would have the benefit of picking sort of the best investment opportunities from each of these GPs.
That's fascinating. Because I was talking to somebody at CalPERS recently, and they were saying that one of the reasons that they like co-investments is because it reduces their fees. And when you're at that size, especially being pension plans, there's a lot of scrutiny on your fees. And so if you can do stuff directly, everybody, your stakeholders are happier. But the problem he was mentioning, exactly like you mentioned, is that there's also asymmetric information. Like, know these investments as well as the GPs do, and there could be some adverse selection bias. Like, are they only, if this was such a great investment, why don't they take 100% of it? Why are they leaving some for us? And there could be very valid reasons for that, like you mentioned, but there's still that concern in the back of your head. It's like, okay, maybe this isn't the best thing, because if it was, they would have wanted it all for themselves. And then his point was like, but they're also not in a position to really do due diligence on those deals because that's not what they do. Like they just allocate to these GPs. And so I did not realize that firms like yours are now doing that for them, right? You're acting as a bunch of things. Like you're aggregating a bunch of these co-investment stakes, but you're also providing the due diligence piece and with your understanding of the managers, but also your understanding of the investments. And I'd be curious if you can talk a little bit more about that part of the process, like the research due diligence that you guys might do on either the GP or the investment directly.
Yeah. So the due diligence process is not too different from what we do in secondaries. For instance, I mean, we would get a memo from the GP, and the GP will share with us all the due diligence that they have relied upon to make the investment. So will not only be the investment memo, but all the CDD, FDDs, all the market reports. But also we would go above and beyond that. We would reach out to our relationships, to our strategic partners, so the other GPs in the space that maybe own the asset before, maybe they are actually the sellers of that particular asset, or they own assets in the space. And so we're able to triangulate information given our relationships in order to make the best informed decision. There's always going to be reliance on the GP that is going to buy and that we're going to be partnering with on that asset, because they are ultimately the group that is going to manage their investment going forward. But in fund of funds, we are very transactional. So we are not operators. We're not gonna manage assets directly. We always invest with the GP between ourselves and the asset. But we need to be very good at determining not only whether there is a good asset, but also whether there is the right GP for that asset. There are certain situations in which we love the asset, we would totally buy it, but the GP that we are going to that is asking us to partner with is not the right one for that particular asset, and it happens very often. And so it's not only a quantitative call, just looking at expected growth of the asset, how much you're paying for it, what costs can be taken out, value levers, but it's also, is the GP aligned? Has the GP the right incentives in place to be able to drive the value going forward?
Can you talk more about that? Why would a GP be a bad partner? Why would the incentives be misaligned? What are some examples?
So on the co-investment side, it's less of a risk because you are investing alongside the GP at a point in time in which the GP is planning to buy assets for their own funds. So you're coming on board on a pari passu basis. I want to expand probably the answer to the continuation funds that we're seeing sprawling over the past, decade, most importantly over the past 4 or 5 years, where alignment is really critical.
What is a continuation fund? Let's start there.
Continuation fund, yeah. A continuation fund is a fund that gets set up by a secondary buyer to buy assets, one or more assets, from a legacy fund that a general partner is managing. So you are taking investments, you are taking companies out of a fund, and you are putting them into a newly established fund with the GP that is going to be the same GP that is going to be managing the companies on a go-forward basis. So it's effectively a reset of time and economics on the assets that gets transferred from a flagship, from a legacy fund into the continuation fund. Why alignment is a particularly important topic here. When a continuation fund, a continuation vehicle gets set up, there is an SPA between the newly established fund and the legacy fund. Because of this transaction, generally, there is some carried interest crystallized in the legacy fund, or you're generating liquidity in the old fund. And price obviously matters. The GP also of the legacy fund. The more you pay for it, the more money the manager and its investors in the legacy fund are going to get. In the new fund, whatever the price you're paying is going to be the new base for the new incentives for the GP. So carried interest, call it 20% of gains above a certain threshold. The lower the price that you pay to the older fund, the more potential carry there is for the GP in the new fund. However, there are situations that we have seen. I've seen multiple in the 2016, 17, 18 period. Some GPs were unable to sell assets to strategics, to other sponsors. They were unable to IPO them. And in order to generate liquidity, they were just trying to find dumb secondary money to basically stop the clock in the old fund and just generate liquidity, take the money, and run. They had very little incentives to drive value going forward because they had already pocketed most of the value from that particular investment. They were just looking for an easy way out from that particular investment. So they were looking for someone to buy their investment so that they could generate economics. The market has developed since then, and now groups like us, like StepStone, we would want the GP to basically pledge 100% or more of what they generate in the old vintages through the transaction, and basically roll it alongside us in the new transaction. Because otherwise, there is the risk of the so-called double dipping. Like you're making carry in the old vintage, you take money out, but then you have another shot, another free option to get new carry in the new fund. Whereas we say, no, you're generating liquidity, you're getting some distributions. We want you to take all this money and put them into the new fund alongside us, so that for you to make money, for you to become rich, you need to do it alongside us. If we have a good performance, you have an extremely good performance. So alignment is in this type of situations is particularly critical, and it becomes difficult at times. And I faced a couple of transactions over the years where the alignment incentives were not set up correctly, and what's the phrase? Show me the incentives, I'll show you the behavior. It's absolutely correct. People look at their own, GPs look at their own wallet. There is a fiduciary duty towards the LPs, but they cannot help themselves. If there is a conflict, they will probably look at their own pocket first. And so you need to set up the structure on the front end. So at the beginning, you need to set it up in a way that sort of protects you from GPs gaming the system. Not only that, but also we would only get in bed, so to speak, with GPs that we know extremely well, that we are invested in. They're super high quality, because they would not jeopardize their relationship with us, with our primary team, with our co-investment team, over a malicious transaction. So the partners, the GPs that we partner with, they are fully aligned with us because they know we will be backers of their strategy on a going forward basis. And this is a repeat business. It's almost never a one-off transaction. When we do transactions, it's because there is a relationship that is probably going to be there for many vintages to come.
Tell me more about the different types of LPs and what their risk reward profile looks like, because you be invested in a continuation fund versus investing directly into that GP from the beginning. Are these two different sets of LPs? Like why would people want one versus the other?
So groups like secondary co-investment funds are generally set up by secondary buyers that are specialized in this type of transactions. The general public, and for general public, I also mean like pensions and general investors, they're not really set up to lead this type of transactions. When there is an option, when there is a transaction of this type, there is generally a status quo option that investors can elect. So when I set up a continuation fund, I buy the assets from a GP fund, there will be like a month like a period where there will be an election period where all the investors in the legacy fund are asked the questions, do you want to take liquidity or you want to reinvest into the transaction alongside this secondary buyer? And not all investors are like-minded in their decisions. Some of them are not even set up to be able to, same as with the co-investment that we were talking about earlier, some of them are not even set up to make this decision. Some of them, by default, they have to take liquidity or they elect to take liquidity. Others actually like the opportunity to double down on the winners in a continuation fund, and they would decide, you know what, I'm receiving 100 million back. I want to invest this 100 million into the new continuation fund because I see the value. But I guess there are different type of LPs. Some of them are more sophisticated and they have in-house specialists that can evaluate the pros and cons of this type of transactions. Many others, they just take liquidity and move on to the next primary commitment. I want to put the split maybe 80-20. So 80, they would just take liquidity and would not even evaluate the investment. Whereas another 20% are a bit more specialized and they will make a reasonable decision, which might be to sell for whatever reason, but they would at least do work on this type of opportunity.
Well, interesting. So you're saying 80% don't even look at it, and then 20% that do, some of them are still going to pass on it, but at least they're taking a look.
Yeah, maybe 70-30. I think the statistics have changed over the years, but I think now between 10 and 20% of LPs roll into a continuation fund. A few years ago, it was maybe a quarter. Now it's 10 to 20 because, given the drought in the private equity market and the slower distribution environment, when people see liquidity, they just want to jump on it without recommitting to the same investments.
Are there certain types of LPs that tend to look at these continuation funds? Is that large allocators, family offices? Like, are there any trends that way?
Yeah, we've seen more and more players going into these continuation funds directly, not leading them. But when there is a continuation fund, generally there are, call it 10, 15 groups that are able to lead this type of transactions. And then there's a big tail of number 15 to number 60 of other groups that can be a part of a syndication process. So generally, these transactions are set up in three steps. So you identify a lead or one or multiple leads. Then you have some sophisticated like co-leads that sort of get you to, 60 to 80% of the capital necessary required. And then you have syndicates that sort of back their due diligence on the leads work. Like if StepStone, if we get into a transaction, if we lead a transaction, many family offices or other institutions, they will say, well, if StepStone is jumping on this, they might have seen, they've done their due diligence. We are sort of fine with jumping on it. And we would get on the phone with them and sort of provide our view also.
It sounds like you guys provide a ton of services, right? And if I'm just any old LP out there, you guys see a ton of stuff. You see everything from the GPs to the co-investments to what other LPs are interested in. And there's a lot of value in this information. Now, why would an LP ever go direct into a GP? Why not? Why wouldn't they always use you guys?
Well, we charge fees, not on the primary side. So here on the primary side, we advise. We are not sort of a middleman. The other reason is access. And that goes back to what I was talking at the beginning. Maybe, if you think about the best investors out there, sometimes there are funds that are still quite small in size and they decide to remain, nimble. They decide to stay small, but a lot of people would throw money at them. And so if you have access to that GP, if you can enter the roster of that GP, you would totally do it. And sometimes we might want to double our commitment to that particular GP, but there's simply no opportunity to do that. So in order to access that particular type of investment, sometimes you can only do it via a GP. via a fund of fund that has already the relationship with that particular GP. You would not be able to access it directly. I mean, not to throw any name unnecessarily, but KKR, Carlyle, this type of names, everybody can invest in those. There's not really a need for a fund of fund specialist to access those GPs. It's more the hidden gems that are more difficult to access.
That makes a ton of sense. I want to go back a little bit to the point you made about the advisory work you do when an LP wants to invest directly in a GP and they don't want to pay your fees. How do you guys charge for that? Is it just based on like an hourly basis, based on the reports you send? How does that advisory part of the business work?
I cannot give too much specifics, but it's basically on a project basis. So they would reach out to us, say, look, we want to do work about this particular manager, and we would perform the analysis and give a recommendation and send it back to them. Or they might come to us and say, look, we have this capital to invest. What would you do with it? And we will give our best ideas on how to best allocate it.
And did this advisory part of the business, was this how StepStone initially started and then you layered in these secondary funds? Is that right?
Yes. And I
Yeah.
apologize, I cannot talk much about StepStone specifically,
Yeah.
but yeah, that's how it started. That was the initial part of the business, and then given the relationships and the goodwill that you build with general managers, other type of businesses were able to sprawl from there.
Yeah. No, I think that's a very amazing way of taking this initial business and then figuring out what else you can do to add value. And with these secondary funds, I mean, it's completely. I mean, it sounds like there's clear need from both sides of the table. We have like LPs or GPs coming to you guys like saying, "Hey, I'm a GP and then one of my LPs wants out. Can you help them?" Or vice versa. Like, yeah, you're an LP and you want some liquidity, and then you're creating that platform for people that want to get in, people that want to get out. And it's it's a phenomenal business that's grown on the back of the advisory work. So that's really cool. What are you seeing as trends now, looking over the next couple of years? Do you see in terms of the growth in either the secondary side, some of these funds, are there new types of funds or structures that are coming out that people are interested in?
So speaking, we see an increase in sector and geographical specialization because generalist funds, you're not diversified, you're not differentiated enough. So I'm also for specialization. So if I know that there is a great healthcare manager out there, I'd rather invest in a pure player and set up my own exposure and my portfolio construction by selecting different pure players rather than going with a broad generalist, not knowing where my capital is going to be allocated. Sort of like the hedge fund pods that have been created over the past 10 years. They became very popular over the past 10 years. So that's one thing. Obviously, secondaries and continuation funds, that is a business in a market that has been booming for the past decade and a half. And there are many other levers for growth. One of these levers in particular is they're the 40 Act funds. So evergreen private equity funds that the public and retail investors can invest in, but they also offer either quarterly or monthly liquidity. So they're less illiquid than investing in a traditional private equity fund. And, there is a ton of inflows from investors for these particular strategies. The real only way to set it up is via secondary transactions, because you are able to buy portfolios that are already mature, that are going to generate already some liquidity that you can sort of use as a flywheel to get the strategy sort of start. So that's something that has brought a lot of capital in the market, and it's probably the most important lever, sort of leg of growth for the next decade, I would say. And another thing, which is probably close to your heart, is sort of the future of AI, sort of in decision making. I actually believe that by 2030, I think I read a statistic that by 2030, 70% of GPs expect AI to be an AC member, a voting AC member in transactions.
Wow.
And, one thing that I actually believe is, I don't know if you know about the anecdote of Einstein's brain being actually smaller than average. When when he died, they sort of measured it, and it actually was weighing like 1.2 kilos versus the average of 1.5. But the problem is that intelligence is not measured on volume, but it's actually measured in the connectors that you have, how dense the connectors in the brain are. And AI is just amazing at making connections that are not obvious to me, to you, and making decisions by being able to deploy these connections in a quick way is really the way to go on a going forward basis in the due diligence process.
Yeah, no, that's a good example, and I obviously definitely believe in the value of AI. I was actually talking to my wife last night. She has a jewelry company, and they've always done collaborations with other brands, and one of the things, there's like, it's a high-end jewelry company, and this is not through AI, but there was like an actual partnership they're considering with a macaroni and cheese company to make like macaroni and cheese shaped like jewelry as like more like a publicity stunt, but it's a very well-known company, and that could be cool. And she was saying that it was it's even her own team was initially going to filter that one out because it didn't make sense, but she loved that idea. And it's, they were going with more traditional kind of partnerships like a hair salon or whatever. And then just out of curiosity, I put that query into ChatGPT to see like, okay, what other partnerships could you come up with? And there's, to your point, making connections from all sorts of things that you'd have never considered, that she was like, oh my God, that's actually kind of a brilliant idea. Like one of the things that came up is to do a partnership with the TSA. Nobody likes the TSA. You're just waiting in line for them to screen you, but they see everybody. And we started talking about this, like, wait, why don't people use that for advertising? Because you have a literally captive audience that's just there waiting to get through this freaking line. Everyone hates them. They could now start making money. We should talk to like Elon Musk and Doge, started getting the TSA to be revenue generating. But then, and then it kind of goes down from there. It's like, realistically, that's probably not gonna happen. They're super bureaucratic, etc. And they were like, well, what about Clear? Like that company that is also next to all the TSA terminals. They certainly want to make money. Like they might be open to some kind of a partnership. And anyway, that's it's something that we can now explore to see if it works. But it was all like an idea that just came off of this random connections that came out of AI.
Amazing.
Cool. Well, Andrea, this is great. Let me end on one question. I'm curious, what are you personally looking for now? If anyone in the audience is interested or is able to help out in any way, what would be the most helpful to you?
Interesting. I didn't think about that. Well, it's something we spoke about last time. Making connection is the best way to generate goodwill. That's the first part. You cannot generate goodwill if you don't have connection, if you don't know people. So if people want to get in touch, and I'm always happy to make new connections, and you never know where things can go. A month ago, 2 months ago when we met, I didn't think that 2 months in I would be on your channel. So that's that.
Yeah, no, for sure. I love that. What's a good way for people to find you? LinkedIn? Where should people go?
LinkedIn probably will be the best bet. So Andrea Pompili. I don't even know. Yeah, no, I think it's just Andrea Pompili, and there should be I should come up, working at StepStone.
The one and only. We can also put a link to your LinkedIn in the show notes.
Yeah, that sounds good. Sounds good.
Well, Andrea, it was a pleasure getting to know you on both a personal and a professional level. I certainly learned a lot, and yeah, glad we randomly started chatting at a conference. Thank you.
Yes,
Thanks again for joining the show.
No, thank you. And I might be in New York over the next month, and I'll reach out.
Absolutely, please do. We're around. No, I'd love to see you in person again.
Awesome. Thank you.